The most valuable buyers of data businesses are on Wall Street. Opus, which was the oil price reporting service that Dow Jones bought, it was growing 6% a year.
6%?
6. They paid, I think, 15 times ARR. It was $120 million in revenue. They paid $1.8 billion. I think, again, this is 3 years ago.
What?
Yeah,
this is insane. Hello, fellow data nerds. My guest today is Craig Fuller. Craig is the founder and CEO of FreightWaves, a freight media company, and SONAR, a supply chain data company. So he's got like multiple things going on. He previously founded and sold Transcard, a fleet payment processor, and built Express Direct, which was a division of US Express, into a $144 million business. He's also the founder of Firecrown, which owns more than 50 publications across aviation, marine, and supply chain sectors. And he recently released his new book, which I just bought, but I haven't yet read, called Moving the World: How Supply Chains Affect All of Us. Craig, that's a long intro, but Craig, welcome to World of DaaS.
I'm very excited to be here.
I'm super excited. Now, for our listeners who are not super familiar with the industry, like what's going on currently in freight?
It's a real interesting time. Obviously, freight is on the front lines of trade policy. It's on the front line of blue-collar labor, immigration. It really sits at the, if you think about freight is all about movement of goods. And so when we think about the movement of goods, it's the Main Street economy. But because it sits in this really interesting place where we're so dependent upon the movement of cargo, 40% of the global economy is in logistics-dependent industries. Anytime there's any major event happening externally, geopolitically, natural disasters, freight plays a central role in that. And so, we've been quite busy this year. The administration has done a lot to change the way.
Right, we've got tariffs, we've got immigration, we've got new, talking about Mexican truck drivers. There's all these different things that are going on, right?
All of that. I think the hottest story right now this week, because it's every week is something different. Is certainly the immigration issue is probably because it is significantly changing the way that the freight market works, particularly in trucking, and it's something that we're covering extensively. And look, I think this administration, for better or worse, is moving so quickly, which, if you run a data and media business that thrives when there's volatile markets, it's actually a good thing, but it's certainly keeping us busy.
And if you like, how does one like even measure the freight business? If you think of, let's say, trucking and stuff like that, is it just like the amount of miles driven, or how does one, like, what are the big measurements that people look at it there?
Yeah, volume of transactions, of total freight transactions across the market is sort of the currency of freight is in the rate per mile. Like, what is for trucking, what does it cost to go from point A to point B? And that's ultimately the commodity that's in freight is ultimately, I'm trying to figure out as a commodity, because freight's a commodity. It's not thought of that way as a commodity, but it really is a commodity because price does determine the outcome of which providers companies do business with. And everything in freight is fungible. A red truck and an orange truck do the same job. Yeah. So ultimately what I'm buying is the time it takes to go from point A to point B. And that's effectively the commodity that people are concerned about is how long does it take to get something from point A to point B. And that's normally in trucking measured on a per mile basis. In air, it's per pound. In ocean, it tends to be per container. And just every sort of nuance in freight has its own sort of currency. Now, what our industry is really concerned about is the volume of transactions, which is really a reflection of the physical goods economy. So if I want to know in a real-time basis, how is the goods economy doing without the distortions you end up with through like credit card spending or same store sales, which gets distorted a lot through inflation and sort of mix of what's being sold. If I want to know what's moving from a volume standpoint through the economy, freight is the most reliable indicator of that because ultimately people are only shipping something if there's demand on the other side. So we get to see the US and global economy for that matter in a near real-time basis. That, like, it at least is related to goods consumption in the Main Street economy. And so what our industry is focused on is what's the volume and then what's the capacity look like in terms of the balance of supply and demand.
And at least the last time I checked, we're seeing like a lower volume of trucking goods right now, but the spot rates are also up. Like, walk us through the math on that.
Well, the freight market's collapsed. I mean, the goods economy in the United States is actually giving off great financial crisis vibes, which is so weird because it's such a difference between what you see in the stock market. The stock market's record highs. Federal Reserve is not convinced that the economy is slowing. But if you look at the goods economy, which has a lot of exposure to manufacturing, a lot of exposure to energy, a lot of exposure to auto, a lot of exposure to housing, that's a very difficult market right now. In fact, if you looked at the industrial side of the data, the volume of freight transactions in the industrial segment is down 30% year over year. So the
Wow.
idea that we're reindustrializing and we're bringing manufacturing back is not supported in the data at all. In fact, quite the opposite is happening. In retail segments, which is where what most people think of the economy, they think of like consumer purchases at retailers and e-commerce. It's flat year over year. It's not bad. It's just flat. But it's that industrial segment that's actually in real deep trouble. And I think what's concerning about that is there's 2 million people who work in the hyperscale AI companies, total Americans, 2 million people. And half of those work for Amazon, by the way. That's what the interesting thing is. You actually have to remove Amazon's warehouse operations and distribution center people. But just for the sake of simplicity, it's 2 million total people work in the hyperscale companies tied to AI and data centers. And 35 million people work in the industrial segments of which we tend to be most exposed to, which includes housing, auto, energy, transportation, and logistics and manufacturing. So what's really concerning about that is not only do we have a K-shaped economy, we have the lower portion of the K-shape, which is the manufacturing segment, and the goods segment is collapsing. And then you have this super high net worth affluent and sort of technology AI that's doing exceptionally well. And I think there's a lot of real concerns about what that means for the broader economy and frankly, for the country. That's probably why there's so much emotion and tension right now because of just the delta between the haves and have-nots.
And where do you see that going over the next 12 months? I mean, it sounds like you're pretty bearish.
Yeah, I'm very bearish when it comes to the goods economy. Now, it certainly could bounce back. We may be near the low, but we're not seeing it right now. We're seeing things deteriorate. Some of it's related to government stimulus or government funding. 45 million people on SNAP benefits. People on SNAP benefits tend to consume more on a per product basis, simply because that you give somebody, and we see this in our data, you give someone, during COVID, we were able to have this sort of incredible lab because you had all of these government stimulus bills that were happening, and we had the real-time freight data that was reflecting on what was happening. And because people were spending money on goods and not services, we got a really, really awesome lab on how fast money goes into the economy and how fast it drives consumption during COVID. So we did this study where we took our data, the freight demand data, and looked at the moments when it was interesting because like every time it looked like freight was about to drop off, then Congress would do some stimulus bill and bam, we're back off to the races. And so when you pull 45 million people away from being able to buy food and consume product, they're naturally going to pull back spending and consumption, and it's going to show up in goods movement through the economy. And it's going to be even more significant than what I'm talking about. And that 30% drop that I talked about in the long haul market, or 17% drop across the whole freight market, that's before we've even hit the government programs and potentially the government shutdown. So it's going to get worse before it gets better. And it's just something that we watch every day because it impacts our market.
Yeah, and we're seeing, I mean, just across the economy, there's so many signs where looks like, credit card debts are going up. People are like, the Vegas economy has collapsed. People are going to Vegas a lot less. So you're looking, the stock of companies like Caesars is down like 50% year over year. You're seeing all these other types of things. So it does seem like the average consumer, maybe not the super high tech consumers we hang out with, but the average consumer is cutting back pretty dramatically year over year.
And it's having a pretty big impact on things like staffing. I mean, UPS, I think, laid off 45,000 people this week. Amazon's cutting back 30,000 people. Now, some of those jobs are in middle management. But I think what's happening is that there's been so much happening geopolitically and so much happening. And look, I think a lot of it was that the economy was propped up through a combination of monetary stimulus and fiscal stimulus, a lot of these congressional programs. And we've stuck, a lot of those have, that money's either been deployed or is not being deployed. And therefore, as we sort of pull back, what we're finding is the underlying economy is much weaker. And the question, and I'm not here to, we could certainly spend all day on this particular topic because people love to debate it. The question, though, becomes how much of the economic growth that we've seen is strictly related to government money into the economy versus the underlying economy. And I think that's a big question because when you look at freight data, which is a moment of truth in terms of consumption, it's just incredibly weak. And it tells us that our economy is in far worse shape than I think a lot of people want to pretend it is.
And there's so much talk about reshoring now. It doesn't sound like you're seeing it in the data yet, but where is that? Do you see some sort of hints that might be coming? Or
what's interesting about that is going into this year, there was a lot of momentum. That's the irony of Donald Trump's policies and I was enthusiastic because I thought what Donald Trump would do would come out with a one and done tariff policy, and it would incent businesses to make long-term plans and manufacturing investments. And if you take the period from say November through even February, we had a lot of announcements of these big investments that were there. And the White House loved to parade these CEOs that were going to invest hundreds of billions of dollars in new production. But if you've noticed over the last couple of months, we're not getting a lot of those announcements. And I think what's happened is, and we certainly do a lot of work in site selection, where companies are looking at, okay, where do I put my manufacturing plant or my warehouse? Yep. They use our data to do those things. We're seeing a lot of companies that had multi-billion-dollar projects that just put them on hold. And it's the uncertainty principle. It's the fact that I don't know what is next when it comes to tariffs and policy. That means I'm just going to go to the sidelines. And you see this in private equity groups. And I know that you've got a venture fund, particularly in PE. These guys can't model. Like, how do I know what to model? Is it 10%? Yeah. Is it 50%? Is it 100%? And I think because of the uncertainty element, which I think Donald Trump would consider a feature, not a bug, it's really causing businesses and business investments to pull back, and that ultimately showing up in the data.
Speaking of data, you run a data business. We love talking about data businesses. When you think about the data that you're collecting, like, how do you think of, like, there's government data or there's all this other data? Like, let me start with government data. Like, what type of government data are you relying on? And then what government data do you wish you had that, like,
None.
maybe you could?
I mean, we have government data, but it's not any of our data. So,
okay.
We take very little government data. We do have an API from Fred, so we take some of the macroeconomic data that Fred publishes, which is the Federal Reserve's sort of, like, it's a very rich database that you can learn all sorts of things. It's sort of the central hub for government data as well as third-party data that the government's licensed. And so we have some data sets we take from Fred, but the vast majority of what we do is not government. It's all proprietary data that we privately sourced that you can't get anywhere else. And so,
so like you're like working directly with trucking companies, and
correct.
There's some sort of like give to get model there or something.
Yeah. So when I started this business, the trucking industry, as an example, has 400,000 trucking companies, and even the largest. Take the top 10 motor carriers.
Because there's so many individual. You're talking about it's just Bob's got his own truck, essentially.
Yeah, Jim Bob or Jose or whatever has one truck, right? And he's one of the motor carriers. The problem is if you take the top 10 trucking companies in the United States, they would only represent 12% of the whole market. So if you're going to go and start a data business and you need a large data set to start, it would be prohibitively expensive to go out and try to source individual participants and individual data sets. Plus, if you go to the largest companies, the question is like, why should I give you my data when I'm not getting anything else in return? So we did it actually the opposite. What we did was we said, look, there's all these software businesses and payments and banks and companies that are sort of the connective tissue, whether it's software or API services or telematics services. They have all this data. And they're not really good at monetizing it because that's pretty much universal of any workflow company doesn't know how to monetize data. I think, Auren, you know this. And so what we found is that we could go to those companies. And what was interesting was we started making these phone calls to these companies. They're kind of like, why would you want it? We delete. And literally, we're like, we want the exhaust data. We don't want the individual. At the time we started, we didn't want the individual identifiable information. We wanted what they considered the backwash or the exhaust data. And they're like, yeah, we deleted off our systems in 24 hours and you're going to pay us for this? And so We got enough of these, and we built exclusive relationships over, some of this stuff is a decade-long exclusives, because there was no value in it as far as the providers of our data were concerned. And so we built some of these sort of macro market level intelligence data sets, was sort of the initial place that we played. And then what we did, the data had never been seen before. Then what we did was we went to the participants, and that's where we did the give to get model. And so we said, look, we have this really exclusive data set that you can't get anywhere else that has all this value. And at first, it was this sort of had to prove the data had value. There was a lot of skepticism, like, does this work? Is it real? Like, how do I understand it? So a lot of education, evangelism. It helps that we have a media business that serves our industry, because that ultimately became the best way to evangelize the data. And now these are the benchmarks of our industry. That's why, if you listen to an investor conference call, they'll mention, they mention the word tender rejection. Nobody knew what that was 7 years ago. And now it's the language of our industry. It's the number one way to determine the balance of supply and demand. But what we did was, once we had this sort of unique data set, then we got the companies to participate, because they wanted to train their own models. They wanted to build better intelligence about their business. And that's where we had more leverage over the relationship once we had the initial sort of starting data sets, which is how we built the business.
And how do you, like, there's data about, like, let's say truck movements and stuff like that, or there's shipping data you can get from the AIS data set or something like that. How do you know what goods are moving?
Yeah, so there are data that we have where we're able to understand what's in those data sets. So AIS data
it's essentially the manifest of what's being moved.
No, it's not through manifest data. It's the message flow from companies. So there's a lot of ways that we do the data science behind it, and we could nerd out on that. But I think ultimately, and freight is as big as a market as it is. Knowing what's the specific commodity in the box is hard to do. But knowing the general flow of that cargo is more important. Now, if you're a hedge fund and you're trying to figure out, we have about 50 plus hedge funds that buy our data. We add about 3 to 5 a month. If you're wanting to know how is Nike's performance versus, say, Under Armour, we're not a very good source for that. But if you're concerned about macroeconomics, then we're as good of a source as you'll find. And so it's important to know that granularity is very valuable if you can get it, but it's also, because it's so valuable, it's also very hard to get. And we don't get into the specific commodity moving. We have ways to get answers out of the data. But,
obviously you might know, like, if you knew, you might know broadly what the type of thing that they're moving or something like that.
Yeah,
like, obviously if they're moving oil or they're moving one of the frozen other data goods or something, right?
We track our telematics devices. So we know how many trailers go in and out of a warehouse. And so like, I can tell you, during COVID, we actually knew which retailers were going to beat earnings and which ones were going to miss based on the flow of cargo through their facilities. I don't know what's on those trucks. Like, I know Target has a bunch of trucks going in and out. I don't know if it's produce or shoes. Now I can look at where those trucks originated from, perhaps, to get an answer, but that's not necessarily what we do. What companies are buying for us is pricing intelligence, the balance of supply and demand, and volume. Those are the three major categories. And we publish.
And how do you think of, like, the data business in general? Like, data business is like, it's a tough business because it's an ingredient, and then someone has to make use of that, right? You're basically sending them, like, facts, right?
Your data Bible, data as a service Bible, was probably the most interesting. That's actually, I think, how we got connected, because I sent you a message. It's like, it's remarkable how you understand, like, you nailed exactly some of the pain. Ultimately, data businesses are as useful as the data is in terms of the person using it. And I think it's very different. And I think you've talked about this, and very different versus workflow companies. And workflow companies, I buy a piece of software and it does this thing. And if it does it well, then I'm going to renew regardless of how much I like it or not, because it's doing that thing that I'm paying it for. And the more painful that it is to switch, the more valuable I have become to that company, regardless of how. And it's funny because you get these in my world and worlds I've been in, where you have these big dominant data software businesses. Everyone loves to hate on them because they sort of have this monopolistic criteria. They're able to sort of squeak every dime, and they know that you can't switch. And that's the beauty of some of these these software platforms, businesses, data businesses don't work that way. At least my experience doesn't. Data businesses are only as useful as taking the data and providing it some use case and outcome for the buyer. And look, we've been on our own journey to learn this, and I don't know that we're very good at it to the degree we want to be, but it's really about making sure that the buyer of the data is doing something with it right after they after they sign the contract. You have this 12-week window that if you don't get them to do something with it and deploy it into some other decision engine, into some other model, to some other outcome, then you're going to lose them. They're going to churn out. And so that's just our rule. We have 12 weeks from the moment they sign the contract to get it into some outcome. And every outcome can be slightly different. There's some universal use cases, and there's this long tail of use cases, which is why data businesses are great, because you have these long tails of things you can do with it. They're also challenging because you have to focus on a couple of wins. But for us, it's the first 12 weeks that really make or break a data business.
And a lot of times, that data just sits on a shelf. So you may have a
Absolutely.
good seller, somebody thinks they want it, but it's not being used effectively.
I think the vast majority of data is that way. I think this is the reason a lot of software companies are really bad at being data businesses, is because they are used to selling a piece of software. They have a professional services group that goes in and implements it, and it's not going to sit on if I'm buying an ERP system.
Do you think data companies should have more professional services to allow companies to help use it?
What we have done is, yes, I think so. And I think that's a mistake that, we're a venture-backed company. And I think our board has historically treated us like they would every SaaS business. Dow and Mal metrics and, NPS scores. And just the way, if you're looking at a SaaS business, there's like a model to determine, you can build these predictive models on whether the customer is going to churn or not. Data businesses don't work that way.
At least you don't even know necessarily how they're using it. Right.
That's often the problem. And one of the things I found was pretty interesting was, so we grew really quickly very early on in our life. We've hit, the freight market has been challenging for the last couple of years. We're in this big freight recession, and growth naturally slows because at some point you become a discretionary item when you're a data business. If you're not embedded into the company's workflow or decision system, you're at that point a screen. And one of the things that happens if you're not embedded into a workflow, which is the ultimate goal for us, if you're a desktop screen product and the person gets laid off or quits or whatever and churns, and there's only one person in the company that knows how to use your data, when you go to renew them, they're like, yeah, but Johnny left and we don't even know how to do it, and we're operating our business. And so Johnny's the entire success of your data business. You're going to end up losing that relationship. So what we've tried to do is, we often also find that the buyer of our data is not the person that actually is responsible for executing it into the organization. So the need of professional services is absolutely paramount. And I think oftentimes at least our board was very against professional services because it was not booked as ARR. And they wanted all of the investments going to drive retention metrics and top of funnel versus driving success. And I think what we've found is that the more embedded we can be as a resource for these companies, because again, we're doing market level data. We have a group called market experts, which are basically, think of them as analysts or economists almost.
Yep.
And their job is to work with the client to basically take our data and make it actionable in their business. And that's super successful. When we do that, there was a period of time where a board did not want any more investments in my market experts because they thought it was just non-value additive. Because again, they're used to selling software services. They're not used to selling data services. And I think we found that that's a really important element for what we do.
Now, you split FreightWaves into kind of two businesses. One is the data business, SONAR, and the second is the media business, FreightWaves.
Yep.
I imagine, just because they have very different profiles, different types of buyers in the end. But there does seem like there's a lot of synergies between the two.
Look, this is a financial engineering element. So if it were my business and I had 100% ownership or even the vast majority ownership, and I wasn't looking for an exit for my investors, then I would keep these businesses together. because naturally the media business, and it still drives top of funnel. The problem is data businesses trade, successful data businesses, I should say, trade at, in some cases, better than SaaS-like multiples if you are the benchmark data service for that industry. So think of like S&P. And you've seen a number, particularly pricing data businesses, PRAs as we would call them, price reporting agencies. These businesses trade at, there's businesses that grow at like 4% a year and are trading at 10 times ARR.
Insane.
They just throw off an enormous amount of cash.
Yeah.
But they're also these businesses.
But even they're trading at 30 times EBIT or something,
correct.
Right? I mean, that's kind of insane. Yeah, given that growth
for
rate,
a business growing at 4%, trading at 30 times EBIT is absolutely nuts.
Yeah.
And there's been a bunch of these deals that have been done. Opus,
why are they trading so high? Like that just it just doesn't make any sense. Like
I think it does if you're the bench. There's all these derivative products
because you think that will help you sell other products or something.
Well, it's derivative. So it's Wall Street that does this. And if you look at like S&Ps, so one of my board members was president of S&P, and they've been one of the most acquisitive companies in buying data businesses.
They've been incredible company.
And he spent a lot of time in financial services around the Bloomberg, the Reuters, or Refinitives, and people like that. And what you find in financial services is that the data itself, once you add derivative products off of it, pricing specifically, you can build billions upon billions of dollars of value in the derivative. Once you're the pricing index and the benchmark of an industry, then the value of that business is related to all of the derivative products that trade off that pricing intelligence. So it's where you see things like the S&P 500 index. All they do is publish an index, and it's a $70 million business for Standard & Poor's. Like it's a piece of data. It's a model, and it's to license it. They generate $70 million because every ETF, every a mutual fund that ties itself to the S&P.
But I mean, if you have a business that is growing at 4% a year and people think it's going to continue to grow at 4% a year, it just doesn't make sense that it trades at 30 times earnings. Like there's just it's just really hard to, unless they think the earnings are going to grow much faster than the revenues or something.
Well, this is all within the last 15 years, right? Like these financial data PRA businesses, price reporting agency businesses, have really sort of caught wind in the last decade. And the reason is because Wall Street, the value of being a benchmark in an industry means that I am able to go create derivative products and derivative source of income that has nothing to do with the underlying subscription to the data product.
Yeah.
And I think
I'm in the wrong business, by the way. Like all my data companies trade at, let's say, 4 to 12 times earnings or something like that.
Well, I think it depends on, it's interesting because we see a lot of data businesses in our space where someone has marketing intelligence or lead generation, things like this. Those are trading at very different multiples. The most valuable buyers of data businesses are on Wall Street.
Yeah.
Where the Wall Street, it's the Preqin sold, I think, for $3.8 billion. I think Blackstone bought it.
But that was growing fast.
It was, I don't know the metrics of the business.
I think they were growing pretty fast, yeah.
But Opus, which was the oil price reporting service that Dow Jones bought, it was growing 6% a year.
6%.
They paid, I think, 15 times ARR. It was 120 million in revenue. They paid 1.8 billion. I think again, this is 3 years ago.
What?
Yeah,
this is insane.
Lloyd's List, which is the oldest data business in the world, growing at 4%. Like growing at inflation levels at 4%, and it traded at 9 times ARR. Like it's because of Wall Street. Because Lloyd's List has the ship registry, they could sell it to insurance companies and they could sell it to Wall Street firms. And that's where all the money's at.
World of DaaS isn't just a podcast. World of DaaS membership is a private, invite-only community for founders and executives of important data and AI businesses. It's a place for off-the-record, high-trust conversations focused on the biggest questions data leaders are facing. The community is about peer learning, curated intros, and access to private events. Everyone in the group is building or leading something meaningful in data. If that sounds like you, apply to join at worldofdaas.com. That's worldofdaas.com. But maybe the buyer just believes like they could grow it much faster or something. And by the way, I know at S&P, they often buy things and then it does grow much faster because they can stuff the channel and they can.
That's the whole thing is if I'm, so we sell a lot into hedge funds. Our pricing data is sold into big financial institutions. And the hardest thing so if you took our business and you plopped it inside of Bloomberg, again, I'm not suggesting that we're selling Bloomberg, although if they're listening to this call,
totally.
They should definitely
By the
call
way, we literally have like hundreds of people from Bloomberg who listen to this every week. So
well, call me up. So I'm happy to have a conversation. Well, let's say that I was to sell FreightWaves or SONAR, my data product, to Bloomberg. What Bloomberg would be able to do is, I had 50 some odd hedge funds. Like I said, we're signing 3 to 5 up a month. The hardest part of being call it a point solution or a very niche data product is getting through corporate procurement, and in financial institutions, it's getting through security compliance, back testing, all the stuff that it takes to get a $100 billion fund to buy your data, that you've got to prove that there's value and there's procurement and all this. Bloomberg already has done all that work. And so for them, they could take my 50 logos in financial services would go to potentially 5,000 almost overnight, because they've already done the work. And they say, hey, we have this new data product that you can subscribe to it. It's $50,000 to $100,000 in ARR, and boom, you're off to the races. And I think it's the same thing with like S&P. They already sell into something like 40,000 corporates. And so for them, adding another data product is just adding another revenue stream that doesn't require them to actually build anything. And the great thing about financial data products specifically is there's nothing to be done. Like if you're reporting benchmark prices every single day, you've already trained the model to do that. And you may have a small team cleansing the data, but these businesses can get to very high margins if you're not growing them. Like if you're putting it inside the S&P or Bloomberg ecosystem, you can get our business to 75, 80% contribution margins and never have a direct sales force that you have to contend with, because you're already in the distribution channel.
Yeah, that makes sense. Okay, so to me that does make sense. So if you're taking a business that is profit of X, and you think like you're going to get it to a profit of 2X, and it's growth of Y, and you think you can get it to growth of like 5Y, right? Well, then, like, it makes sense to pay a very high multiple on it, because you're confident you can go do that. But if when the private equity firm buys it, then it makes no sense, because like
PE firms are bad buyers of these data businesses. Now, company like Fast Markets, which was a media publisher up until 2017, has created a price reporting agency for minerals and metals, really sort of bespoke, like lithium and cobalt and things like that. That business, I think the last it transacted, it was 120 million top line or ARR. I think it transacted at like 1.8 billion, growing at like mid-teens growth, 15, 20%.
And definitely in the wrong business here.
It's price reporting. The price reporting stuff is incredibly valuable because of all the derivative products that you can offer.
You're right. Price is the most valuable thing of data.
Absolutely.
Right? You need data that's temporal, otherwise it's not valuable. And you need data, ideally, that has a dollar sign next to it. Right. That is what I've learned in the data business.
If you're a benchmark service, if you are the benchmark index in a space, then that means that you are irreplaceable because physical contracts, pricing contracts are sold against your data.
Yeah.
Derivative products on Wall Street are sold against your data. People have to have the subscription or they effectively are out of business. And so there's all these derivative values, and you could build software, insurance products out of it. Like the great thing about pricing data businesses is there's a universally addressable opportunity market. And like Dow Jones, you don't have to go very far in history to actually see Dow Jones bought Opus.
Yep.
I believe 65% of their revenue is now data businesses. And it's the fastest growing component. Go look at Hearst. Hearst is a big media conglomerate. I believe the majority of their revenue comes from their data businesses, with Fitch Ratings being the biggest. And so I think when you have companies that have very large distribution in the market selling financial services products, they will pay a very large multiple for these data businesses.
I mean, it makes sense. If you think of like the biggest data company built in the last 30 years is CoStar. And they have great data on leases and, all those types of things. And those things change quite often.
And Auren, everybody hates them that's in the industry. Like they're
universally
hates
a lot of these big companies. They're always haters out there.
if you talk to somebody that's ever competed against CoStar. They're very litigious.
They're a tough competitor. They use lawyers. They use everything at their disposal. But gosh, that stock's been awesome.
Oh, I mean, to own it, right, is a different thing. But the thing is, like, everyone loves to hate them. That's in the business, but they can't do anything about it because they're so dependent upon it.
Yeah,
and that's where you want to be as a data business. You want to be indispensable for the customer's business cannot exist without you, and that's where you want to be, and that's when you can secrete as much value from your data as possible. Unfortunately, there's not a lot of businesses that actually work that way.
Yeah,
pricing is one of those.
All right, let's go back to the trucking world. You published some data showing that 4% of truck drivers don't have commercial driver's license. That actually seemed pretty low. I would have thought it'd been way higher. Is that a surprise or?
Well, I mean, it's 120,000 people that don't have commercial driver's license. That's just the ones that don't have it.
Yeah. I just presume like lots of people are driving these things like on the sly and stuff like that.
You would hope not, but that's a number. There's also the non-domiciled CDLs, which are basically people who don't have work permits that are given commercial driver's license by the states. So there's about 600,000 under the administration. There's about 600,000 truck drivers that are probably going to be put out of business as the administration goes through this enforcement regime to really call it stamp down on some of the what they view as some of the more egregious actions. And look, I would say that's a positive thing because a lot of what we've seen over the last decade is this constant movement to deregulation, which meant, look, you and I could open up a CDL school tomorrow. We just go into the government registry and say that we're a CDL school, advertise online for $500 to get your CDL. The person could watch a video, never actually driven a truck. This is insane.
What?
This is true. Never driven a truck. They come to our CDL, we call them CDL mills.
Yeah.
Never driven a truck, never been in a truck. And as long as they can go past the CDL test, and in some cases, it wasn't even required because we could actually, in certain states, give a CDL as the school. We could say, hey, you paid us $500. We want you to be successful. Here's your CDL. And it's a bunch of fraud.
Wait, so I could have a CDL by next week if I want to.
Have a CDL over the next hour if you want.
Sitting in my living room.
It's so ridiculous. And so here's the problem.
Oh my gosh.
You
I kind of want to have a commercial driver's license. That'd be cool. Like driving around one of those trucks.
Well, as long as you're not hauling 80,000 pounds down the highway.
No, I would do it in the right way because I would be a little scared to drive one of those trucks.
Then you should take about 6 weeks to get your CDL. But what's happened is the last 5 years is the industry has pushed to allow more people to become truck drivers. And what's interesting about it, it was actually pushed by all the large trucking companies wanted a bunch of truck drivers to come in. It's this whole supply and demand thing. We're trying to educate them what they did to themselves. So they put these rules in place that they thought they could make it more difficult for small carriers to grow. But then they opened the door for truck drivers to come in. But then these entrepreneurs, a lot of them are new immigrants who had problems finding work, ended up realizing that there is no checks. Like literally, you and I could start a trucking company. In the next 5 minutes, we could go register a trucking company. We don't even have to prove to the government who we are. Like literally, go online, fill out a form, boom, we have a trucking company. And then I'm going to issue a CDL to you, my brother, or Auren. We're going to do it here online. You've never driven a truck. You don't even know who I am. And now we have a trucking company. And that's what's happened to the trucking industry. Because now we don't care about the rules. We'll drive.
And are we seeing like a lot of accidents and stuff?
Absolutely. There's more than 5,000 fatal accidents for American truck drivers, American trucks in the United States a year. That's up 40% since 2014.
5,000 accidents.
5,000 fatal accidents. Fatal.
Okay, obviously that means we have a lot of more. We have, at least 10x more like serious accidents or something.
That's right. That's right. We're in the couple 100,000, but it is a travesty what has happened. And it's been pushed upon by the largest trucking companies. What they thought was regulatory capture we're trying to make it harder for small guys to open trucking companies. But then what they also did was try to make it easier to hire truck drivers. So they thought, hey, we can
do both.
It totally backfired. And it's destroyed the economics of the entire industry. I mean, the biggest trucking companies, like this is the worst quarter in their history. A lot of big trucking companies are at risk of going bankrupt.
Wow.
because they have no pricing power and it's become a commodity. And that's what the Trump administration is trying to get a handle on is get rid of a lot of the bad practices and guys that they, we don't know who's in our trucks and whether
When
they
I've
actually
talked to
know what they're doing.
people that drive their own, either own their own trucks or own a small trucking company and stuff like that, it still seems like so backward, like the way they get orders. And a lot
Oh
of times
yeah.
it's like someone calling them up and there's no good app for it or
Well,
anything. And then they
there
have
are
to like make a
marketplaces.
determination, like, does it really make sense for me to drive from Pittsburgh to Dallas or something? And, it's
There
like,
are marketplaces, and look,
yeah,
venture
sure.
capitalists have burned more money than they know what to do with.
Yeah,
They're
there's so many that went.
chasing this
There's ones that
dream.
all these guys Convoy and raised billions of dollars that went
Yep.
under. Yeah,
But I think Auren Convoy, Dan Lewis is a good
Uber
friend of mine.
Freight. Yeah, yeah.
Convoy if you looked at Convoy's cap table and its investors, it had a dream roster of investors.
Of course. Yeah,
It
yeah.
had
They had
Bill
everybody. Reed Hoffman was involved even.
Reid Hoffman was
they
in
had
there. Jeff
amazing
Bezos
people.
was
Yeah,
in
yeah.
there. Bill Gates was on the cap table.
Wow.
Bono from U2 is cool,
Oh
right?
yeah, of course. If he's invested, it must be good.
Henry
Yeah,
Kravis
yeah.
was in it. I mean, it was the
Jeez. Wow.
roster upon
Oh.
rosters upon rosters. And even major funds like Fidelity were in it and T. Rowe Price. The problem is that those investors did not understand the trucking industry. And I have a rule basically of any successful freight and logistics company. Now, a lot of investors have their own rules and a lot of investors will say, I need a technical co-founder. I need someone that I can vouch for their technical co-founders. I have my own rule, which is, and this has been true in every single case. In fact, Convoy, Dan Lewis was the only counter example to this exception. Was you must have a founder. One of the founders must have 4 years of industry experience. That is what makes a unicorn in freight. And without it, that company is unlikely to survive.
But there's so many, amazing companies and so many industries, including freight, right? Right. I mean, did the founder of FedEx have any, much?
Well, but this is also the
years.
1960s, right? Like,
I know, but still, like,
well, the founder of
yeah,
FedEx, I mean,
yeah.
his grandfather founded Greyhound.
Okay. All right.
So the founder of FedEx understood, the hub and spoke of transportation networks.
Or like Ryan Peterson from Flexport.
Ryan Peterson owned a company called Import Genius, which is a data business that tracks imports.
Okay. All right. Okay. You're proving me wrong.
We can go through the list. I mean, Jack McCandless, the founder of Project 44, worked at Yellow, worked at the Walmart account at Yellow.
Okay.
Spent 8 years. He built a $4 billion market. We can go through the list.
Got it. So how about, because it's just it's so hard to understand. Yeah, it's so nuanced. Yeah,
it's nuanced. There's as every industry.
I mean, if you have to say like if you're talking about logistics in general, like for Uber would be like the logistics business with no experience.
Uber,
yeah.
Uber, even though they've poured billions of dollars in freight, is an unsuccessful player.
In freight. Yeah.
They've spent billions of dollars building out Uber Freight. And the only thing that really drives the Uber Freight business isn't Uber, even though it's called Uber Freight. They bought a business called Transplace, which managed about $15 billion of freight and rolled that into Uber Freight. And that's the predominance of the Uber Freight business, is a business that they bought. And so it is, look, freight's a hard business.
If I want to back a founder in freight, you're saying they should have at least 4 years of experience in freight.
Or they need to go find a co-founder. And I think you'll find that that's universally true. I do about 30 seed investments a year in freight. I'm probably one of the more active seed investors in freight and logistics.
Clearly, if you do 30 in freight a year,
I know if I was a fund,
you are the most active.
If I was a fund, I would be like, I'm almost like, but there's small checks. I'm not writing.
We're still number one. I mean, there's no one more active in freight if you're doing 30 a year.
Look, my general expectation is that founder, and I get a lot of inbound, probably 10 a week, of companies that want, and they find me because I sit on all sides of the world. I'm from the industry. My father started what became one of the largest trucking companies. My uncle also started a different company that was my dad's crosstown rival that became also one of the largest. So I'm a traditional trucker. Like I have diesel in my blood, as I like to say. I come from big trucking.
Awesome.
But then I also sit in a world of venture, and then I have a large media presence. So oftentimes founders, industry people that want to go start a business know very little about starting a tech business. So they end up coming to me because they're trying to figure out how to enter the tech ecosystem. Or I get outsiders that know nothing about logistics, and I'm sort of their first stop. And I always tell them, like, look, if you don't have a co-founder that understands logistics, you need to go find one. because it's going to be incredibly painful. The things that you naively think that you can change through whatever your technology is or service is, what you think is happening is oftentimes not the reason something happens. I mean, oftentimes venture capitalists look at the logistics market and think these guys are, particularly trucking, these guys are a bunch of hillbillies. How are they not centralized all the transactions? And then they get into it. They spend, just like Convoy did,
Yeah.
a couple $100 million making really boneheaded. The guys at Convoy are good friends. The founders were, and the team, but they made some boneheaded decisions. They bought 5,000 trailers. These are boxes, thinking that they could automate them. What they should have done is bought a trucking company that knows how to manage assets, because they would have spent a lot less money buying a broken trucking company with a couple thousand assets than trying to do it themselves. And I think what happens is they realize when you're moving physical products, it's very different than moving data. Like moving information, which is ultimately financial services and payments, and that's moving information at the end of the day. Yeah, you're moving money, but it's really you're trading information across whatever landscape it is. When you're moving a physical product and trying to digitize the physical world, the three-dimensional world, that is a very different world that doesn't live inside of a data or a digital universe. You have the analog world that you have to contend with. And oftentimes there are a bunch of rules in place that exist because that's the way the industry operates. And I think oftentimes these founders that know nothing about supply chain or freight think that they do, and they just get absolutely clobbered.
Now, I love to talk about the media business. What if I want to get into the media business? What advice would you give me? You've been, to do, or would your advice be like, stay away?
I didn't set out to be a media entrepreneur. When I was starting FreightWaves, we started to build a futures market based on trucking. That was the original concept. And then we said, okay, there's every commodity market, every commodity contract, futures market that's been built has two components. They have a news business and they have a data business. Like if you look at oil, every liquid financial contract, there's a whole news business, even in crypto, which really wasn't a big thing when we were starting out in 17. There's a whole news business to it, and there's a whole data business to it. That didn't exist. And so when we started our business, we actually tried to get press because I needed to evangelize it. And I got turned down by a bunch of PR agencies, which is like getting turned down by lawyers. And I remember I called up Convoy. I figured if anyone could make Convoy look like a futuristic venture capital backed tech disruptor, if whoever Convoy's PR department was, I needed them because they made this thing look like absolutely awesome technology. And the industry knew it as another freight broker. And the guy quoted me $40,000 a month to take me on a retainer. And I'd only raised $2 million at this point. And I remember just being like, he's like, dude, I think you should basically hire your own. Your concept is really hard to explain. You should hire your own social media writer to write content. So he posted this job, and an editor at a trucking publication applied for the job. And I hired him, and I told him, his name was Brian. I said, Brian, I want you to write about trucking, but you can't write about futures that often because nobody will read it if it's all about that. So write about stuff that's happening in the market. And he did, and it was moderately successful. But then he went on vacation, and a hurricane hit Houston. And I had just, in my prior life, had ran FEMA's disaster logistics, which is a disaster. But I ran the disaster logistics for FEMA.
Yeah.
And this was the hurricanes that hit Houston. And he was on vacation. I didn't want to bother him because I knew what to expect when the hurricane hit. I wrote this article, What to Expect When Expecting a Hurricane. And there hadn't been a big storm in like a decade that hit the United States, like a big storm in a major city. And the site exploded, absolutely exploded to traffic. Now, everyone thinks they're reading Brian Straight's content, but they're actually reading mine. He was pissed, by the way, because I was writing in his name. And I'm sure there was a ton of spelling and grammatical. I got C's and F's in English, man. I was like, I didn't think I could ever write. And at that moment, I realized that there was this huge opportunity to sort of lean into this media business to basically use our data. And a friend of mine gave me Bloomberg's biography, Bloomberg by Bloomberg. And he's like, hey, I think you should read it. And I read it. And it was like, I could take what Bloomberg did in financial services and I could just apply it into trucking. And that's really been the case ever since, as we took the biography of a guy who, started out in the 80s where the data was hard to get. It was disparate. A lot of people don't realize this, but Bloomberg didn't have a lot of data when it started out. It had some very hard to get data that was pretty valuable, but incredibly hard to get to. And they built it out over time. And that's exactly how Bloomberg built their business. And that's really what we've done at FreightWaves.
Interesting.
So how do you get into media? I don't know. I mean, we got to 10 million of ARR without even understanding that you could go buy leads and do traditional top of funnel marketing. Like I didn't even have a marketing department until we got to 10 million of ARR. By the way, Bloomberg didn't have a marketing department until they got to 8 billion of ARR. So
wow,
they made my case story look like a joke.
Yeah, even better. Yeah. Okay.
They didn't have that's the great thing about media businesses.
Now, at one point you bought Flying Magazine. You bought it for like about $2.5 million. Like, why did you do that? And kind of walk us through that kind of playbook.
So, Auren, I was bored. I was middle COVID, 2021, and I started flying airplanes again because I had been a pilot and I sort of stopped flying. Life takes over. And I started reading all of the aviation media businesses. And flying was like the Sports Illustrated back in my day. And I was like, man, they don't do a very good job. I could do a better job. And of course, as a media entrepreneur, I'm thinking, I wonder if I could buy this. And this will be like my pet trophy asset that I'll like keep. And so I reached out to them. And there was a guy named Craig Fuller who ran the Aircraft Owners and Pilots Association who had the same exact name.
Hilarious.
So they thought they were talking to Craig Fuller, the other Craig
Fuller. Got it.
And so they agreed to have a conversation. They said, hey, it's not for sale, but we'll consider selling it.
It's funny. Whenever I reach out to people, I always reach out with my other email address, which says LeBron James. So.
Very, very similar. And so I get on this call, and I think they're shocked because the other Craig Fuller, which we actually had we did a panel about 2 years ago. It was Craig Fuller and Craig Fuller. Anyways, they're shocked because I'm like half the age. And so I'm on this call and they agreed to sell it to me. So I did it. I bought it as a side hustle. And I wanted to call it hubris, call it ego, call it like entrepreneurial, whatever you want to, madness. I wanted to see if the same idea of taking a media business could drive top of funnel the same way I built FreightWaves to buy top of funnel the data business.
Yeah.
And I also wanted to build a headquarters, but I wanted to build this is COVID madness, we'll call it. So I was going to build a community that had a landing strip, and we're going to basically build a bunch of homes in a residential neighborhood.
That's cool.
1,500 acres outside of Chattanooga, Tennessee. And in our own magazines, we started advertising that we're going to build this community. And within the first 3 months, we got to $28 million of reservation contracts. Like it wasn't $28 million, but reservations were like, deposits were $10,000 a quarter acre, 40,000 an acre, something like that. And we had sold. And what I realized at that moment was this power of having media wasn't just applied to my data business, but it applied to any other kind of business. And so we coined the term negative CAC, which is the idea of basically I have a media business which makes profits, but its primary goal is to provide top of funnel for some other product services.
And by the way, that's what influencers do, right? So influencers,
I didn't invent anything.
So if you have a big X following or Instagram following or whatever, like that's how they monetize all.
That's exactly what it is. The difference here is that and I've done this with FreightWaves, but rather than, you could say I'm a freight influencer. It's not very sexy. It's not going to win me a lot of dates if I were single, which I'm not, but it certainly won't win me a lot of attention. But what the difference here is I'm buying these old school legacy magazines that have been around for 50 to 100 years. And what I found with that is it's basically the influencer halo in these communities, because people love Flying Magazine, or if you're into trains, you love trains. And they just have such great brand affinity for these connections. And you'll hear these older people that talk about, I have every issue that you guys have made since 1960.
Yeah, totally.
And stuff. And what you find is you get this massively important audience in that community. But the difference between, say, a traditional influencer and the types of businesses that we buy is we're not paying the kind of valuation that a Mr. Beast would want. I mean, again, he's in his own world, but it's the same fundamentals. If I have an audience, I can drive top of funnel. We're paying 3 to 5 times EBITDA.
It makes sense. And these brands, Fly Magazine, Trends, like they're enduring. Like people still talk about the Time Person of the Year. Like I don't know anyone who's read Time Magazine in the last 20 years. Like
no, but they still have. It's
yeah.
an important thing, and I think there's actually this thing called the Lindy effect. I don't know if you've ever heard it, but
yeah, of course, yeah.
So it's the idea that if something's been around for 50 years, it'll be around for another 50 years. And I think when we're buying a media asset like Flying or Trains or Gotti magazine in 1907, if these things have survived multiple world wars and multiple
totally.
pandemics and recessions and even waves of the internet, chances are, and they still have subscribers and advertising, chances are it's going to live on another 100 years.
Yeah.
My team.
And there's often a conference associated with it. And there's a community around it. And, et cetera.
They buy merch with it because they want to be a part of that community. And what's interesting about it is like, so my team, we brought a lot of young a lot of times they haven't digitized these assets very well. They're sort of stuck in the print world. So I bring a lot of young people into the business. And there's like some crisis. Every business has a crisis. And you could just see a kid who, is a new manager, never had, more than maybe 2 people reporting to them. So now got 20 people reporting to them. And they panic. They're like, oh my God, this is going to kill us. Like something happens. Like, I don't know, somebody leaves or somebody, a hater writes an article or is like, oh my God, they panic because they think this is the end of the world. And I remind them that like, if these businesses have been around as long as they had, it's really hard to screw it up. Like,
yeah, totally.
You have a lot of lead, and what you also find is the audiences want you to be successful. They will. There's an element of a legacy media business that I think doesn't exist in a lot of other communities. Probably comparable to like a sports team, maybe like a museum or some type of like. Something very traditional. You don't get it in a lot of businesses, but you do get it in media, traditional media, where they almost feel like they have ownership of the product. It's their community. And they hold you accountable to as the owner to making sure that you're preserving that asset for them, for their use. But what's great about it is if you make a mistake and you screw up, they're also there to help you figure out, they want to be on that journey along with you. And I think there's something to be said for that, because I think oftentimes as entrepreneurs, we're running businesses, we're buying businesses, and we're sort of on our own. Nobody cares about whether we're successful. And I always tell people, think about it, because I grew up in sort of the cable TV of age things. Remember you had a TV show that you cared a lot about, and all of a sudden ABC cancels it or something, and you're just totally. You're like, why do they do this? And you can't wait to just have it come back, and maybe occasionally they'll drop a special and you're like, oh, I want that so much. I think traditional media, particularly magazines, print magazines, have that same kind of audience connection that's just, it's unbeatable.
A couple of personal questions that we ask all of our guests. First one is, what conspiracy theory do you believe?
I didn't used to be a conspiratist or someone who believed in a lot of conspiracy. I have a bunch of them now, which is really unfortunate because I used to think it's there. I certainly believe in UFOs, and I believe that we're probably being visited in the consciousness that we have is not the world. And so therefore sort of metaphysical, I'll say, almost religious in some ways. But I actually believe that I'm a big fan of quantum theory. And so I believe that we've actually lived out our life before, and these are just reflections in time. So hologram effect is effectively what that is. Again, I can nerd out on that, but I don't know if anyone wants to hear me nerd out.
I love that. All right, that's awesome. Last question we ask all of our guests: what conventional wisdom or advice do you think is generally bad advice?
Conventional wisdom or advice. I have a problem with breakfast. I know that's like a real boring one, but growing up as a kid in the 80s, I was told I had to have breakfast. And it was like, that was sort of the universal truth that you had to have 3 meals a day. And obviously that's not true. So big cereal that's my conspiracy too. So
big conspiracy.
Not a big point of wisdom. I mean, I could say don't follow.
Well, I rarely ever eat breakfast. I usually just have some black coffee, but that's just really because I'm not that hungry.
When breakfast is such a sham.
Yeah, totally.
So it is absolutely shit. Now I could say like, don't follow your dreams, or don't follow like what's the old? I think Jeff Bezos says, don't get into a business because you love it. Don't follow what you love, but follow where you can make money or something like that.
Oh, really? Okay.
But I don't know that anyone wants to hear me expound cliche wisdoms.
All right, well, this has been awesome. Thank you, Craig Fuller, the other Craig Fuller, for joining us on World of DaaS. I follow you at Freight Alley on X. You have great content there. I definitely encourage our listeners to engage you there. This has been a ton of fun, and I really appreciate your time.
Appreciate it, Auren. Take care. Thanks for having me.
Thanks for listening. If you haven't already done so, please subscribe to World of DaaS wherever you consume your podcasts, YouTube, Apple, Spotify, and more. And please help us get discovered by leaving a review. And check out worldofdaas.com. That's worldofdaas, DAAS.com. And of course, connect with me on Twitter at Auren. That's AUREN. Would absolutely love to hear from you.